Okay, my friends, happy Wednesday. Welcome to our flow session. We're going to spend 30 minutes or so looking at this specific question of, hey, before I buy the stock, what should I do? Or should I buy this stock? Or how should I do that? We're going to dive in the deep in pretty quickly and hopefully leave you on the other side with some skills to go forward and make some better decisions. So with that, let's jump in, shall we? So first, just a reminder of risk. This is one of the only things you can control in markets, and as an investor is risk. We don't have outcomes that are guaranteed, but we can guarantee where we apply risk and how we use risk. And one of the first steps of becoming a better investor is just getting better with risk. We'll keep coming back to that as we go along the way. If we've not met, my name is Josh. Why should you care at all what I have to say? I've been in markets for almost 15 years now, both the equity and future side. A way of describing my experience in markets is if you've had a retirement account that has a mutual fund in it, that mutual fund buys participation in funds that make market decisions. So I'm the guy that would make the decisions in a fund that would be sold to mutual funds or pension funds and then ultimately shows up in a retirement account. So a couple steps removed from the guy that's actually sitting across from you and says, hey, get into this fund. What's the upside is I actually know what the market does. So the other guy is, he's a salesman. It's okay. It's a good gig if you can get it. And I luckily am one of the co-founders of Miiflo. So kind of the context of what we're trying to do here is answer a challenge that is facing anybody with an investment horizon that's more than 15 years out. There's a significant challenge to getting to the bogey of a quote unquote comfortable retirement. And if you run the math, the number now that is suggested that you hit is 3 million. So what does that require? Using the existing playbook that is farmed out by every financial advisor on the planet, with some exceptions. It's going to require that you invest about 23 grand a year, every year for 35 years using the current playbook to get to that 3 million. And by the way, you get to that 3 million, that is about 125K annual salary. Okay. So that number keeps going higher in terms of what we need for retirement because things are more expensive. And how do we go around that? What's some additional context? So one, I would say that the financial services industry has done a really good job of convincing you that 6.7% annual returns is good. So all that math that says you need 23,000, that is based on 6.7% inflation adjusted returns. The other thing that they've done a good job at, which we'll challenge to a degree, is that the only way to position yourself is long. So if you're not familiar with that kind of nomenclature, what does that mean? So if you are in a position where you want prices to go higher, you are long that position. If you are in a position where you want prices to go lower, that's short. So long and short. Almost all investing products and positioning is based on a long portfolio. So that means that it only grows as prices go higher. What's great is that
recording in progress.
Is that you can actually approach this in ways that don't require it to go higher. You can actually grow assets if markets go sideways or if they go lower. So this idea that you have to be long only is a place that I'd want to challenge that notion. And then last, I would have you know that you have the ability to access an investing playbook that does that actually benefits whether markets go higher, lower, or sideways. And so if we have, let's say, for example, that we have another period like we did in the last decade of persistent inflation in the 70s into the 80s, nominally the S&P 500 lost money for a decade, even though prices went higher, but because inflation was higher than the rate of appreciation of the index, you actually lost money. Okay, so having another playbook is a way to get around some of that risk. So what can we do? There's a couple things that we can do, and this discussion here is going to be part of that. One is it turns out that there's two dials that we can turn that radically change that outcome. So one is yield, right? So if the current playbook that's often given is a 6.7% inflation adjusted return, if you could crank the yield to say 25% a year, you could see the same outcome but not need $23,000 to invest. You need about 300. That is a remarkably different approach. It becomes far more affordable to actually save for retirement. But to access a playbook that does that, and they do exist, you can't do that with a long only stock buying or index buying portfolio. You need a different playbook that requires not just the yield, but it requires more skill. So one of the questions, and I think by just showing up and being on the session is evidence of that, is that if you're willing to take more responsibility for your investing outcomes, you can tap in to those types of playbooks that can give you those better yields. And that's what Miiflo exists for. Like, we exist as a platform to go alongside brokerage accounts. Like, money doesn't get parked with us, but we help you leverage this new playbook and the skills to execute off of it so that you can get better outcomes and hopefully not need $23,000 a year for 35 years to get where you want to go. Okay? So that's the setup. Now let's talk about what we're going after for today around this idea of, hey, should I buy the stock? Or before I buy the stock, what should I do? Well, one, I want to hopefully expand your imagination for ways to invest. So we're going to expand your toolkit. We're going to expand your playbook. Second, I want to give you some simple frameworks that you can use tomorrow that will absolutely make you better tomorrow as an investor. And then last, I want to put you on a path for further exploration. So, think of this as like dropping you off in the deep end, and hopefully you can find the edge. We won't be able to cover all of that, but maybe this kind of piques some curiosity on ways that you could approach investing that you didn't know existed. And so if we leave with you having understanding around that'd be a really great outcome. Okay, so with all that said, let's jump into the task at hand, and that is, hey, what do you think? Should I buy the stock? Right? This happens to me all the time. I get people that come to me because they know I've been in markets, and they'll say, oh yeah, what about the stock? What do you think? Well, let's talk about buying a stock, and let's talk about, if you want to do that, how are ways to do that can give you a better approach for success in the world that we find ourselves in. First, let's just talk about how the P&L profile looks for a stock. Okay, so here we have a P&L profile for a stock. What does this mean? This means that as price goes higher, we have a linear increase in profit. Pretty easy to understand, right? Buy low, sell high is the idea. Some of you may have had the experience of buy high, sell low, depending on your timing. But overall, the idea behind buying a stock, essentially you just have to be right on price. Because if it's higher price than where you got in, you can make some money on that. And that's appealing to people. What are some drawbacks around this idea of buying a stock? Well, one is that whenever you buy a stock, it is only ever a 50-50 bet. So there is really no edge statistically or quantitatively in buying a stock. In fact, Jack Bogle was right. And if you're unfamiliar with who Jack Bogle is, so Jack is the founder of the Vanguard ETF. He would stand in front of people and say, hey, the math is really, really clear. I mean, it's really, really clear. Humans are terrible at picking stocks. It with few exceptions, there are some, but with few exceptions, over a 20-year rate, almost no one can beat the performance of the S&P 500. So that's that 6.7% inflation-adjusted return. That's from the S&P 500, which is the benchmark that everyone uses. Almost no one can beat the performance of that over a 20-year basis. Now, are there periods where you can certainly exceed that? Absolutely. But on a long period of time, and if you're trying to build a retirement savings, you're trying to grow wealth, just be clear about the odds. The odds are not in your favor. So if that's the case, just as a start, they're not in your favor. How could we at least tip the scales to give ourselves a better chance if this was something that you wanted to pursue and still think that it's something that you can do? My first offer to you is this: don't invest unless you first answer 4 questions. Okay, so this is a simple framework that some of you have heard, and you've heard me say this ad nauseum for years, and I keep banging the table about this because this is the one process that I can give you that I guarantee will make you better tomorrow. Right? There's other things I could give you that will make you better over time, but this will absolutely make you better by the time you get up tomorrow after you sleep. So what are these 4 questions? So first is, what's the opportunity or the target? Okay, so I could actually make you a significantly better investor relative to most of your peers if before you enter a trade, you decided to know where was the target. Okay, so let's look at a real life example from kind of where we are in the world that we find ourselves in. And let me get to the right chart here. Where is it? Where is it? Maybe this isn't it. Here we go. Great. Fantastic. All right. So here we have a daily chart. We're actually going to go look at a weekly chart of Bitcoin. Okay. Let's talk about this. I talk about this because this is in the news, and you could use a cryptocurrency. I mean, you could replace cryptocurrency for a stock, and we could use the same framework. But where we are currently is a buy zone for me. Now, I don't ever want to buy unless I have in mind a destination or a target. And so for me, the destination that I think is achievable in some near term is 150K. Okay, that's the area. So if I'm buying in this area, I'm looking for taking off at 150K. How and why do I come up with that number? So we can actually model, and this comes to the idea of targets. Like, how do you come up with a target? And is that a fool's errand? Because how could you know where it goes? Well, yes and no. We live in a world where the tail wags the dog. So what do I mean by that? It means that most of the products that we look at, whether that's stocks or ETFs, the price ranges that they move in are driven by derivatives around them. And those derivatives are transparent. Every market participant can see them, and they have probabilities around them based on when we could be at a certain price at a certain time. So for example, if you said, hey, what's the probable range of the S&P 500 a year from now, we'd use some calculus, and we can calculate the expected range of the S&P for the next 365 days with a 70% probability that we'll stay and close the year inside of that range. How is that possible? It's because these derivative products are transparent, and it'd be like if you go to, let's say you imagine you go to Vegas, or if you play poker. I mean, if you understand the probabilities around poker, imagine how you would play if you could see everyone's hands. So there's parts of the mechanics of poker that work out because you can't see everyone's hands, and so you're trying to figure out, okay, what are the probability that this person has this? But what if you could see that they had that? What if you could see that the person across from the table had pocket aces? You would likely do different things. You would probably be more conservative in what you did because the probability that they're going to get beat is less. Or maybe after the river comes, you can see that they've got most of a straight or a flush, and you're like, wow, like I'm going to fold. I'm not going to go against that. That's essentially what these derivative markets do, and so that helps set these ranges where we can actually predict within a certain period of time what are the probable ranges, what are the reasonable ranges, and that's how I anticipate targets. So targets are the first question. What is the target? If you don't have a target, or if you don't have a way to determine a price target, then it's real simple. You don't have an investment. Just stop right there. But I think I think most people understand this dynamic because outside of markets, like if you run a business, let's say that you buy homes to flip. Uh, People that do that buy homes, they want to fix them up and flip them. Well, they know what the market will bring. They know what they could put into this property, and they know how long before it doesn't work out for them, and they could flip it. And this is important to know what they could possibly get, because then they can decide, what am I willing to risk? What am I willing to risk? The risk is relative to the opportunity. And I look to always establish, if I can, especially if I'm making a directional bet, where the opportunity is an asymmetric reward to risk. So let's go back and look at our Bitcoin perspective here. So if I use, let's see, where's the tool? Nope. I think it's this one. So here I'm looking to go to 150K. Essentially anywhere inside of this box is where I'm looking to buy. And if I trade below 95K, then I'm out. But this is the area that I'm willing to risk this much to get to that destination. Okay, and if that fails, then I'd see if I get to my next zone, if we go to there, but then my target's going to change, because some of the timing of when it can happen, all that is in place. So like right now, I'm right there. I'm in the buy zone, and I can buy in here. It makes sense for me, and as long as I hold this area, I'm good. So those are the first two questions. What's the opportunity? What am I willing to risk? Third question, what would tell me that I'm right? So whenever we place and enter an investment, because we don't know what's going to happen yet, we're all storytellers. We're all looking at the far right side of the chart, and we're trying to make a decision. We don't know what's going to come yet. And so then what happens is we actually have to envision in our mind, how should that go? Why is that important? Because that helps us stay in this investment, even if the price isn't exactly what we're looking for. But if the story hasn't changed, or what we believe is going to happen doesn't change, we can stay in that. So let's look at this example with Bitcoin. So what's my idea is that entering in this area, I am not going to trade below 96 or 95. If I'm going to get back above here, I could stay in this range for a little bit, but eventually this is going to break out and push to the upside. That's what I believe is going to happen here. In Bitcoin. Well, that's what I should believe would happen. Now, next to that is the last question. What would tell me that I'm wrong? And this is actually even more important than any of the, aside from the first one, which is where's the opportunity, the last one of where that I know that I'm wrong is critical, because if I have a story for how this is going to play out and it doesn't follow that narrative, I am not in flow with what is going on. I should get to the sidelines and then reassess. Get back to cash. Cash is a position. Okay? It's from that place that you can have, your brain can be released to reassess without the emotional attachment. Part of the reason to asking these 4 questions before you enter and having an answer to them is so that you can access that information once you're in it. There's been exhaustive studies, specifically on the Global Financial Research Network. So this is a division of SSRN, which is Social Science Research Network. It's pre-flight academic papers, lots of study around behavior of investors emotionally, psychologically, when they have risk. So as soon as you commit risk, once you click the button and say buy, now you're emotionally attached to that. And as humans, we don't like to be wrong. Just a couple months ago, a buddy of mine sent me a picture of a stock, like a screenshot of a stock. And he's like, oh yeah, here's the stock. And I was like, I don't know what the stock is. And he's like, oh, this is great. What it turned out is that he had bought this stock like 4 years ago, and he did not have a price target. It had been underwater for 4 years, and now it's just back to break even. So I'm not really excited about this idea. For one, because what's the downside for my friend here is that he had 4 years of opportunity cost because he didn't know where this thing wasn't working. He could have exited the position, gone and invested in something else, and then when he saw it come back to the price it was now, get back in. And he would have been net even better than where he was, where now he's not back to break even because of the lost opportunity cost of other investments he could have been in because he didn't have the answers to the 4 questions. And even still, he's back to break even, but he doesn't know what the target is. So, how much heat he took or how much of a drawdown he took in this thing, hoping it would come back. That's pain that we actually don't have to experience. But to be able to avoid that, we have to be able to actually go in and go, yeah, no, I don't. Here's how I know that I'm wrong. So, what shouldn't happen here in Bitcoin? I should not trade below 96K. If I trade below 96K, then I'm going to get back to the sidelines and I'm going to reassess. I'll reassess. And, because I'm looking at this area, we've spent quite a bit of time in here. If we can stay in this area, I'm fine. If we test around and come back up into it, then I could have a defined area that I want to defend. But I mean, if we fail here, we can easily slip down to this next area of inventory. And even beyond that, we could slip down to this one. And now I'm starting to take on heat, which if I just got to the side, let's imagine that I just got to cash and then we trade all the way back down here and I bought and I establish here rather than having the position here and hoping it comes back. I'm in a much, much better position. And per my plan is if we trade below 60K, well, then I believe that Bitcoin's going to go all the way back to 20K. And I don't want it at that point. That would be giving back several years of appreciation in this and would likely suggest a much larger systemic problem with the whole space. Okay. So those 4 questions, I have those 4 questions in mind, and I don't enter unless I have in play. So basically, it's real simple. No answers to the 4 questions, no investment. All right? Now, next. Okay, let's say I've answered the 4 questions. What else can I do? So let's say you've gone through the process and you've looked at the underlying vehicle and you decided, oh yeah, I actually do like this. What else could I do? So here's some things that you could do that I don't think many people understand are available to them. So 1, you can leverage options to add probability and make better use of risk capital. So let's go back to our P&L chart here, okay? So now on this one, I just have to be right on price. That's all I have to be right on is price. But it's a lot of capital. I could be more capital efficient with this. And this is just a 50-50 bet. How could I make it a better bet? I could start to introduce options. So if you're unfamiliar with options, options are established as an insurance vehicle that you could use to hedge portfolio risk, but they themselves have value that's based on the movement of the underlying vehicle. They're a leveraged way to express the same idea. So I can buy a call option. There's call options and put options. A call option basically means that I'm buying the right, not the obligation, to acquire a share of a stock at a certain price in a certain time. A put option, if I'm buying it, gives me the option or the right, not the obligation, to put shares of stock to someone at a certain price at a certain period of time. So they're like coupons that allow me to do things, and in and of themselves, in isolation, they can offer a better way to manage capital than a stock. So let's look at the stock, and then let's look at what a call option would be. Now notice the difference here. If I buy the stock, for every dollar that I go lower, I lose money at the same rate as if I go higher. If I have a call option, there's a floor. There's a floor, meaning I can have an asymmetric upside to the downside. This is really, really interesting. I could have the same opportunity, but actually have a floor. And not only that, I can do this at a much more capital efficient way. It's going to cost much less capital to have the same exposure as the stock. Fairly interesting. We're going to look at a real-time example here in just a second. Then, while that gives me better capital, it doesn't necessarily answer the probability issue. And if I, on a stock, if I want to win on a stock, all I need to have right is price. If I want to win with an option, I have to be right on price and time. So we already talked about it's hard enough to be right on a stock. So let's add additional difficulty and use an option where now I have to be right on price and I have to have it within the right time to make that work. Sure, it can be less capital, so that's great. It can have a fixed floor, that's great, but we have this problem of the probability in there. And so the way around that is to stay in the option world, but to use multiple options together. So this is a buy call butterfly. There's actually 4 options used all at the same time. And what's fascinating about this is it preserves the floor of just buying an option, but it's actually less expensive than buying that option. And I will make money as long as I'm between a couple different prices at expiration. So I just have a range. It's much more probable that I get into a range of prices than trying to get to a specific price target. Okay? So let's look at like a real example and flesh this out some more. So 3 ways to invest, all betting on the idea that a stock will move higher. So first, I could buy the stock, I could buy one option, or I could buy a call butterfly. So I can have the stock, I can buy one option, or 4 contracts in the butterfly. Well, let's look at these and how they're constructed. So we're going to use the SPY. So that is the ETF that tracks the S&P 500. And in this example, this is an example I put together a while back. But at the time, we were trading at $530 a share. So in 30 days, the projected target was 560. Okay, so the expected range was that we could get to 560. That was a reasonable target. So how could I express that between these 3 different options and way to do that? Right? Here's the way that works. So let's do buying 100 shares. So at $530 a share, that would be $53,000 in capital. If I get to the price target at 560, it's about $3,500 in return, which is about a 6% return on capital. Okay, so I mean, 6% is not bad. Remember that the 20-year average of the S&P is 6.7%. So 6% in 30 days, pretty good. Okay, but I could do better than that. If I do one call, now there's a fixed window that this thing expires, but I could buy one call. It's going to cost $2,040 in capital. If I get to 560, then I would see a profit of $1,850, which would be a 90% return on capital. So you can see why it's advantageous to look at, if I want to be long, if I want to buy this thing, let's look at options. And you can be smart about it. The best way to do that is to go at a very much like of long duration. Whenever you buy an option, you can buy them at different expiration cycles. If you want one to be a stock replacement, you want to be way out in time. Okay, and I'm talking like at least 90 days, if not more. If you get inside of 45 days, the probability of getting to that target starts to diminish with every single day. You get inside of 21 days and it almost always loses. Okay, so if you want to use it as a stock replacement, push it out in time. Push it out a year. It'll act the most like a stock, but give you a way to do that that is much, much more capital efficient, right? But we're not done. Now let's look at buying the butterfly. So in this case, you're going to buy the 530 call, you're going to sell the 560 call, 2 of them, and then you're going to buy a 590 call. So 4 option contracts, but look at this. $825 of capital is required for this to get $2,000 in max profit if we are at 560 at expiration, which would represent a 240% return on capital. Now, to get the max profit, I need to be at that price target. So if, as we can see here on the P&L, like that at expiration, depending on where I am, is going to change what that profit will look like. But almost all of these, and this is the floor of what I would lose. That'd be my max loss if, and I would only realize that if I'm below 530 at expiration. As long as I'm above 530, this is what I'm looking at. Okay? Much, much better way to express. So let's pull that full circle. So when a friend of mine says, hey, what do you think about buying this stock? I know that the probability is not great of picking a stock. I first go to, well, what's a reasonable target that I could build around within a certain period of time that's a reasonable target to achieve? And this is not all of the Wall Street analysts and the reports. The sad thing about the industry is a lot of that is just made up. Some of it comes from there's already a position that the firm holds in that stock, and this is the price that they want it to be at to exit their position. And guess what? They want you to go after that target so that you will buy it high enough that then they can transfer the risk to you. Isn't that wonderful? No, let's not do that. Let's not play that game. We don't have to play that game. Let's build it around what's an actual probable or reasonable target, and that's going to be set based on what's happening in the options market. So that can build these reasonable ranges within 1 month out, 3 months out, 6 months out, and so forth. So from there, then I'm going to go and construct that as a butterfly, because it's going to be the most capital efficient way to do that. And I just have to be within a range of prices within this period of time, and I'm good. Now, here's what's also fascinating about this whole deal. Let's go back to our final slide here. Okay. Now we know that on this one, price could go down where I have it and come back, and I'm back to break even. On this one, if I don't get within the certain period of time, it will expire worthless, and I'll just have the max loss. Sometimes I have seen call options where someone buys that call option and it eventually comes back to the price that you want, but not within the right time. And then it's no bueno. But these, you can be, because there's such a small amount of capital, like sometimes I'll construct these around something and I have them almost as insurance. I pay for them. So I basically have paid for the max loss through other investments. And then I'm just camping on these. And then all of a sudden they come into that expiration range and they just absolutely explode higher. That's not available in the other ways. And you wouldn't want to keep that out there if it tied up a lot of capital. But by having the butterfly like this, it allows you to not tie a lot of capital up, but have exposure to some pretty great outcomes. And this is how we do it. I mean, this is the Wall Street, Chicago way to approach that. And that's one of the ways it separates institutional professional players from retail, is that we know how to be capital efficient and we know how to do it with probability. We know that nothing is guaranteed. That's okay. We don't have to have that be guaranteed, but we want to be efficient with capital that we can control. We want to know where we're wrong, that we can control. We want to build it around something that is reasonable to achieve. Great. We can control all of those things. So let's build our investments around that and see if we don't get better outcomes. We find that we actually do. Now, here's another way that this can expand your imagination for what's possible. And that is that these multi-leg option strategies exist for whether a stock goes higher, lower, or sideways. So, I gave you an example to supplant what happens if, we believe that we're going to go higher, right? But we don't have to have that be the case. We can actually build them if they're going to go sideways or lower. In fact, this is the back end of Miiflo. Okay, all of these are investment ideas that are offered for today. They're valid for today, meaning that the underlying stock meets the criteria for this specific multi-leg option strategy. And most of these, so let's just look at a couple of these. So these are iron condors, and this is an iron butterfly, and this is an iron condor. All of these four are built on the idea that the stock is going to go sideways. Okay? Here's buy-put butterfly. So buy-put butterfly is the same idea as the buy-call butterfly, but it believes that the stock will go like this. So right here, we've teed up 6 ideas. I mean, there are even more. Here's one. Here's a buy iron butterfly. So here's one where a stock is going like this, and we don't know if it's going to go higher or lower. And guess what? We don't care. This will benefit whether it goes higher or lower from where it is. How cool is that? it can radically expand what's possible in your playbook and in your investing outcomes if you tap into a investing playbook that can go higher, lower, or sideways, that uses efficient capital and introduces probability. For example, these iron condors, okay? When you enter, so if you remember, we talked about what's the probability of buying a stock. It's always just 50-50. And it's 50-50 because you're making a directional bet. On a iron condor, which is what's called a credit spread, we can talk more about that in future sessions. On this one, on the day I enter, there's an 80% probability of profit on the day I enter it. And I'm going to be in this for 20 to 40 days maximum. Pretty cool. What's the hard part about this? The hard part is knowing what stock is a good candidate for that strategy in what time. And that's the part that we try to take care of with Miiflo is basically build those candidates and then offer them to you, and then you can decide which ones best fit where you want to allocate within your portfolio. But that playbook exists. It's available. You could tap into it tomorrow and see if you get better outcomes. Okay, gang. So some takeaways that I hope that you have as we wrap up and land the plane here. One is that, again, you begin with the end in mind. Have the exit in mind before you ever enter. And that is part of you answering the 4 questions. So if you don't have an answer to the 4 questions, you don't have a trade or an investment. And then use multi-leg options to reduce capital and increase your return on capital. And if you do that, then I think you'll be in a much, much better position. Okay. Thanks for the time. Thanks. I hope this has been helpful. We do these every other week, so we'll be back in 2 weeks with another flow session. And if you want to look at what it could look like to tap into a new playbook, you can always sign up for a trial of Miiflo. We offer a free month for anybody who wants to try that. And you can start with a practice account that allows you to try these ideas immediately and just see how different investing can be in that type of world. All right. Okay. Thanks, gang. We will see you soon. Cheers.